Welcome to Talk Tickers. Today we're diving into the latest earnings call from Copart Incorporated.
Yep, Q3 fiscal 25.
Exactly. And our goal here is, to cut through the usual earnings call talk and really pull out the key information, the insights from what management said.
Right, give you the important takeaways without you having to sift through the whole thing. We'll guide you through the numbers, the commentary, what seems to matter most for where Copart's at and where they might be going.
Okay, so let's kick off with the headline numbers. A quick snapshot. Global revenue looked pretty solid.
Yeah, $1.2 billion globally for the quarter.
And profitability, how did that shake out?
Also looked positive. GAAP net income, that increased by just over 6% compared to last year, came in at $407 million.
Which translates to per share.
242 cents per diluted common share. So yeah, pretty steady growth on the bottom line there.
Okay. Now, unit sales. Those numbers always tell a story. And this time, maybe you need a little context. Global unit sales were up 1% year over year.
On the surface, yes, 1%. But management made sure to point out that the comparison quarter last year actually had one extra business day.
Ah, right. So if you adjust for that.
If you adjust for that, the global unit growth was actually over 2% on a per business day basis. So it kind of smooths out that comparison, makes it look a bit stronger.
Okay, that makes sense. And breaking that down by region.
U.S. unit sales were basically flat year over year. But international, that showed healthier growth, up 6%.
Interesting. And what about ASPs, the average selling prices?
Also saw a lift. Globally, ASPs were up around 3%.
And within that?
U.S. insurance ASPs specifically were up over 2%. International insurance ASPs, though, had an even stronger bump, up about 5%.
So again, international showing strength, both in unit growth and price increases this quarter. Higher prices per vehicle, obviously good for revenue.
Definitely a positive driver.
And inventory. Did we see movement there?
We did. A notable decrease, actually. Global inventory was down almost 10% compared to last year.
And in the U.S.?
U.S. inventory specifically was down about 11%. Could be faster cycle times, maybe strong demand, or just a different mix of cars on the lots.
Okay, so summing up the top line, results look stable. Maybe slightly positive, especially if you factor in that calendar quirk with the business days.
Right.
Let's dig deeper then. Financials, segment performance, global service revenue, that's their core, right? How did that do?
Looked healthy. Up over 9% globally.
And the drivers?
That was driven by an 8% increase in U.S. service revenue. And again, a really strong jump, 18% in international service revenue.
18% internationally is quite strong. Did management flag anything specific hitting U.S. costs this quarter? I think I recall something about facility costs.
They did, yeah. About $6 million in incremental costs tied back to Hurricanes Helene and Milton.
Okay, so storm-related.
Exactly. But it wasn't new spending this quarter. It was recognizing deferred expenses for those CIC units, catastrophe units as they actually got sold. It's just part of how they account for storm processing over time.
Got it. Now let's talk about purchased vehicle sales. That segment seemed, a bit more complex this time around.
Yeah, that's a good way to put it. Globally, the revenue was down 2%, which, okay, not huge.
Yeah.
But the gross profit, that was down about 60%.
60%. That number really jumps out.
It really does. And it gets even starker in the U.S. U.S. purchased vehicle gross profit was down around 187%.
Wow. Okay, how does that happen? There must be an explanation.
There is. A big chunk of that was a $12 million out-of-period adjustment, basically catching up on some costs related to the first 2 quarters of this fiscal year.
Ah, so a look-back adjustment.
Exactly. Management did provide some context, saying year-to-date, the U.S. purchase unit margins were actually just over 6%. So that gives you a better feel for the underlying performance, kind of stripping out that big adjustment.
Okay, that's crucial context then. That 187% drop isn't the whole story. What about the international purchased vehicle side? Because that looked weird too. Revenue down 25%, but gross profit up 22%.
Yeah, seems counterintuitive, right? But it reflects a shift happening in some markets, particularly Germany.
What kind of shift?
Some insurance clients there are moving away from purchase contracts where Copart buys the car towards consignment models, where Copart just sells it for them for a fee.
Okay.
So when this involves higher ASP vehicles moving to consignment, plus they had stronger purchase unit margins in places like the UK, it meant less revenue from selling purchase cars internationally, but better profitability on the ones they did buy. Plus, of course, growing service fees from the consignment side.
Okay. So less volume maybe on the direct purchase side internationally, but the mix shifted towards higher margin consignment, and the purchase cars they did handle had better margins. That makes sense.
Precise.
And facility costs overall. Up 12% globally and in the U.S. What's the story there?
Management was pretty clear. Ongoing strategic investments, they're expanding capacity, adding land, building facilities to support future growth.
So investment mode.
Yep. Even if you pull out those hurricane costs we talked about, U.S. facility costs per unit were still up about 10% year over year. So definitely investing.
Okay, let's pivot a bit. Key business drivers, trends they discussed. We mentioned insurance volumes being sort of flat globally and in the U.S., though up slightly on that per-day basis.
Right. But what's really interesting, and management spent some time on this, is the underlying trend. Total loss frequency keeps climbing.
Right, I saw that number. What was it?
In the U.S., it hit 22.8% in the first calendar quarter of 2025. That's up about a full percentage point, 100 basis points from last year.
22.8%, so almost 23% of damaged vehicles and claims are being totaled.
Exactly. And the reasons remain pretty consistent. Vehicles are getting more complex, stuffed with tech. Repair costs, parts, labor, even storage, rental cars, they just keep rising.
Makes repairs less attractive versus just totaling it and selling the salvage.
Especially when you factor in that global buyer base. For buyers in emerging economies, buying a damaged U.S. car for parts or repair can be way more affordable than other options. That demand supports salvage values.
Which brings up a key question management tackled. If total loss frequency is rising steadily, why haven't their reported insurance volumes kept pace? Why aren't they seeing a bigger surge?
Good question. They mention a couple of things. First, different sources might measure total loss frequency slightly differently, so there's some noise there.
Okay.
But maybe more significantly, they pointed to cyclical factors, specifically an increase over the last 4 years or so in the number of uninsured and underinsured drivers on the road.
Right, and how does that impact Copart's flow if someone's uninsured?
Well, if the person at fault doesn't have insurance or not enough insurance, their damaged vehicle might not enter that standard insurance claim process where the insurer makes a total loss decision and assigns it straight to Copart.
So the bypass is the main channel.
It can, yeah. That vehicle might eventually get to Copart through other routes. Maybe the owner sells it via cash for cars, or it ends up as a repo going through a lender, or maybe a dealer takes it. But it's not that immediate efficient flow you get from the big insurance carriers.
Gotcha. So the rise in uninsured drivers acts like a headwind, kind of masking some of the volume increase you'd otherwise expect from just looking at total loss frequency trends.
Yeah.
That's a really important nuance.
It is. And while that core insurance volume was flattish, they did highlight strong growth elsewhere.
In non-insurance parts of the business.
Exactly. The blue car segment, that's banks, rental companies, fleet operators, that grew almost 14%.
14% is solid.
And dealer sales volume was also up over 3%. So those diversified areas are definitely contributing growth.
Okay. Shifting gears slightly again, did they mention the heavy equipment space?
Briefly, noted some softness there, maybe tied to, uncertainty around infrastructure projects or tariffs hitting equipment values. Their partner, Purple Wave, saw basically flat gross transaction value, GTV, year over year for the trailing 12 months.
So, maybe a minor drag, but not a huge part of Copart's overall picture.
Seems that way, yeah.
Looking forward, they talked quite a bit about operational readiness, especially with forecasts predicting an active 2025 storm season.
Yeah, they stress that getting ready for state events, catastrophes, is something they do all year round. It's not just a seasonal scramble.
Did they give any concrete examples?
They did. The big one was the acquisition of Hall Ranch down in South Florida.
Hall Ranch, how big is that?
It adds nearly 400 usable acres. Huge.
Wow. And what does that mean practically for storms?
It gives them massive additional storage capacity specifically for big hurricane events. They said it's enough space to handle a storm more than 3 times the size of their largest ever Florida events.
3 times? That's some serious surge capacity they built.
Absolutely. It shows they're serious about being prepared.
And it sounds like beyond just storm prep, they're generally in investment mode.
No question. They kept hitting that theme. Investing in physical storage capacity broadly, investing in their tech platform, which is crucial for everything they do, investing in people, and just building out the whole ecosystem for both buyers and sellers.
Okay, let's try and put some of this into context for, the experienced investors listening.
Yeah.
That whole discussion around trade policy, tariffs, especially on parts imports, That feels very relevant right now.
Oh, definitely. It creates a really dynamic situation and, frankly, quite a bit of uncertainty for their insurance clients.
How so?
Well, tariffs on imported auto parts directly push up the cost of repairs. And since most parts are imported,
Right.
it just makes repairing vehicles less attractive economically compared to totaling them out.
So in a way, government policy is kind of pushing things towards Copart's model,
Yeah,
reinforcing the economics.
that's one angle, yeah. The potential offset, though, is if tariffs or other things cause new car shortages and drive up used car prices significantly.
Because higher used car prices mean higher salvage values.
Exactly, which would benefit Copart through higher ASPs. Management actually compared it a bit to the 2021 chip crisis, but noted these tariffs are focused more on repair parts, which might actually be slightly more favorable to Copart's model than the chip shortage was because it directly discourages repairs. But yeah, lots of uncertainty until there's more guidance on details like USMCA exceptions.
Understanding how prices get set in their auctions is also pretty fundamental for investors.
Right. And management explained it's largely driven by that global buyer base bidding against each other.
The arbitrage opportunity.
That's the key. Buyers in countries where cars are much more expensive can often pay more for a salvage vehicle than someone just looking at local scrap value. Copart's platform basically finds the highest bidder globally for that specific car, whatever its condition or type, that maximizes the return.
And what about market share? Management seemed less focused on chasing short-term share numbers.
Yeah, they kind of framed market share as an outcome, not the primary goal. It gets influenced by things they don't control, like how fast individual insurance clients grow or reporting period timing.
So what do they focus on?
The inputs. Delivering the best possible net returns to their clients. That means investing in the land, the tech, the tools like Title Express, using AI. They believe if they nail those fundamentals, the market share takes care of itself over the long run.
Makes sense. Switching to costs, G&A, general and administrative expenses were up. What was driving that?
Mostly investment, again. They specifically mentioned building out the sales team for Purple Wave, their heavy equipment platform, and other platform services.
So not necessarily a new permanent baseline for costs.
They suggested not. They framed G&A increases as strategic spending designed to drive future efficiency, leverage, or cost reduction. It's an investment mindset expecting a return.
We talked earlier about that challenge from uninsured and underinsured drivers, kind of bypassing the main insurance channel. What's the key takeaway for an investor there?
It basically means a slice of the potential total loss pie isn't getting to Copart as quickly or efficiently as the insured vehicles. They might still get those cars eventually through Cash for Cars or dealer channels.
But it's slower, less predictable.
Exactly. It's a volume headwind they're actively managing by growing those other non-insurance segments. Diversification helps offset it.
And lastly, they touched on potential legislation, like capping storage fees at tow yards.
Right. Their take was that could actually be a slight positive. If tow yards can't charge excessive fees, insurance companies might retrieve cars faster, potentially getting them into Copart's system quicker.
Interesting. And what about laws trying to raise the threshold for when a car must be totaled based on repair cost percentage?
Management seemed pretty unconcerned. Their view is that economically, insurance companies probably don't total enough cars already. They think these kinds of mechanical percentage rules are unlikely to really change the fundamental economic decisions insurers make, unlike, say, mandatory repair laws, which aren't really a thing in the US anyway.
Okay, now let's move to that part of the deep dive where we explicitly say this is absolutely not financial advice.
Definitely not. Purely for entertainment, speculation, a thought experiment based only on what we heard in the call.
Think of it like pitching a kind of wild but maybe plausible trade idea stemming from these insights.
All right, let's throw out a couple of highly speculative scenarios, just building on these dynamics we've discussed. Remember, not advice.
Okay, idea one, a paired trade.
Yeah.
You're playing that squeeze on repair economics against maybe a cyclical recovery in insured driving. How would that look?
You could hypothetically go long on a major salvage player like Copart. The bet is that the long-term trend of more total losses, boosted by repair costs and maybe these tariffs, keeps driving volume and value for them.
Yeah. And the other side of the pair.
You could short a basket of auto parts suppliers, especially those really reliant on imports. The thesis: rising repair costs and tariffs make totaling more likely, potentially dampening overall repair demand or squeezing supplier margins. You're essentially betting the total loss channel gains at the expense of the repair channel, partly thanks to policy.
Okay. Speculative idea number two. Something weather-related.
Yeah. Given those forecasts for an active storm season and Copart talking up their readiness, their huge capacity investments like Hall Ranch,
Yeah.
you could consider something like a call option spread on Copart.
Betting on their ability to handle a big sick-tea event.
Exactly. Betting they can process a surge in volume efficiently and benefit from that flow. And maybe you hedge that slightly.
Yeah.
Maybe with a short position in, say, a regional auto body shop chain. The idea being they might struggle with parts delays made worse by tariffs or face more competition for the repairable cars left after a big storm when Copart is handling the totals.
Okay, I cannot stress this enough, folks. That was not financial advice.
Absolutely not. Purely hypothetical scenarios, just brainstorming based on the call commentary.
So let's quickly recap the main takeaways from this deep dive. Headline results looked stable, but with some important details under the surface, like that adjustment in U.S. purchased vehicles and the positive shift to consignment internationally.
Right, and that core trend of rising total loss frequency, still very much intact, driven by repair economics. But near-term insurance volumes are getting buffeted by things like the number of uninsured drivers. Non-insurance segments, though, showing good growth.
And critically, they are investing heavily. Strategic spending on capacity, tech, storm readiness, like that massive Hall Ranch site. That's a clear theme.
Plus, you've got those macro factors like trade policy and tariffs adding uncertainty, but potentially also reinforcing the economics favoring total loss over repair.
Remember, this whole discussion was just for informational purposes. Definitely not investment advice.
Please keep that in mind.
As you think about all this, maybe consider how the whole landscape of car ownership, repair costs, and what happens to damaged vehicles might keep changing. What's the long-term value of all that land Copart owns? What does their logistics power mean down the road?
Yeah, lots to think about. What other questions would you ask management if you had the chance? Always good to keep pondering.
Thanks for joining us on Talk Tickers for this deep dive. We'll catch you on the next one.